Hi, good day everyone, and welcome to our lesson number 23. This is Majia H speaking. We're going to be doing budget processing, which is under chapter 5, working capital and cash management. So today's lesson, we're going to be covering page 238 to 245 on your Finance in Media textbook, 4th edition. Please make sure that you also watch the link of the recording so that you can gain more understanding of the budgeting process and the whole budget concept. So it is always important that you attend your classes regularly, participate in the engagement and class activities, and also complete textbook activities that will also be covered under this lesson. So in terms of today's lesson, we have already introduced the chapter, which is chapter 5, working capital and cash management. We have already covered the working capital as well as the relationship between risk and reward, as well as explaining what the budget concept is all about, as well as doing some practical question of budget during class and online class. So under today's lesson, we're going to be covering understanding the budget process as well as the master budget. So under today's lesson, budget processes. So in terms of budget processes, we mostly talk about the master budget, which is an integrated and holistic budgeting process where we actually get to see the full company budgeting tools or what the company expect in the next coming financial period. So with the master budget, we talk more of operating budgets as well as financial budget. So it gets to be splitted into two. So it is a document indicating how the company is going to spend its money, starting from how it's going to generate money and what are the resources that will be needed up to the overheads that the company is going to incur. So that is the whole picture of what a master budget will look like. So depending on the organization, so preparing a master budget or preparing a budget will depend on the size of the company or how big the company is. So the bigger the company, the more department it have, the bigger the budget it will be, and the bigger the cash outflow and inflow of cash that will be forecasted will be. So here it says that some processes are relatively short and simple, whilst others, such as of a large established business, are so elaborate that they may take several months to complete. So depending on the business and how big the business is, we expect the preparation of a master budget to take longer period. If it is a small company that only have got like 4 or 5 division, we expect it to take less than 2 months. And if we're talking about a company that have got over 5 division or departments, then we expect it to take longer because every department will actually have to come up with their own budget based on their own operating activities, which will have to make sure that they are all in line with the business objective. So a typical budget processing comprises of the following step. The first step, it is the formation of the budget committee. So for every budget, we need to have a budget committee. People will sit around and look in terms of the full picture of the company, where the company wants to go and where it is currently sitting at. And again, they'll also take a look in terms of the availability of capital that will have to be used to finance this business operation. And then secondly, we're going to take a look at the determination of the budget period. How long is our budget period, and are we going to split it into different blocks, or we're going to do it as a full financial year budget? And then we're also going to talk about specification of a budget guideline, what needs to be followed, what are the guidelines, what are the protocol procedures that will have to be used to govern the budget. And then we're going to also then talk about the preparation of the initial budget process, and then budget negotiation, where each and every department will come in, negotiate and defend their own budget if they have been requested to do their own budget. So in where a company decide that each and every department have to do their own budget, in most cases we end up having negotiation where every department comes in and sit in with the budget committee and then present their budget and then defend their budget. And after that, the budget will either be reviewed again or will have to be approved. And then once it's approved, then we do a budget revision at a later stage, or what we call an audit budget, to see if that department is still following with what they've actually planned, or they've actually overspended, or they're still underspending, or they are in line with their they're in line with their budget. So those are the budgeting processes that we are going to talk about today, that leads to the preparation of a master budget. So here there are the steps of budgeting process. We're going to take a look at step number 1, formation of a budget committee. So here it says that a standing budget committee will usually be responsible for holistic policy matters relating to the budget program and for coordinating the preparation of the budget itself. So they are there to coordinate, to make sure that the budget preparation is done properly and every department is following all the guidelines and rules in terms of preparation of the budget. And every department, in most cases, they are always given a certain target or a certain amount of money that they can spend. And if we're also talking about revenue generation, they'll also give them a limited amount or a specific budget to say that we need to achieve the following number of sales so that we can be able to achieve the following certain objective. So the budget committee usually comprises of a minimum of 3 people. So we're going to have a chief executive officer, chief financial officer, as well as other senior managers or the chief operating officer. So those will be the main 3 key executive directors who are going to be there to manage all the budget of the company. And then we're going to have senior managers and middle managers coming in with their department budget, which they will then make sure that the CEO, CFO, and the COO make sure that all of these are still in line with the strategy of the business or the business objective. And then the budget committee is the highest authority in the organization for all matters relating to the cash inflow and outflow of cash. So they're the one that regulate how much money should go out, where and when, and how is the capital that have been provided by investors should be spent in the business. So they are the ones that have got the right in terms of authorization of any large cash flow amount. And once the budget are prepared, every department manager will therefore have the right to actually have put authorization over small outflow of cash, but large cash flows will be governed by the audit committee and will have to be signed off by the audit committee or by the budget committee to make sure that everything that is being spent on have been approved. So the committee sets or approves the overall budget goals for the organization, directs and coordinate the budget preparation, and resolve conflict and difference that may arise during the budget preparation. In some cases, you find that there might be conflict where 2 departments are actually having a fight in terms of budget allocation. One department is being they are giving it a higher budget price or a higher amount of capital that it actually have to spend than the other, whereas the other department is the one that is mostly active during the operation of the business and it actually requires a lot. So the budget committee will also be there to resolve such conflict as well as lower or any challenges that may come during the budget preparation. Also approve final budget, monitors operation against budget throughout the year, and reviews operating result at the end of the period. So they are also there to make sure that they assess and check if we are deviating from what we actually planned, and if we're deviating, what are the causes of our deviation from what we actually planned, and then how do we resolve that. So uh, that's another job that the budget committee actually do. This is the first step that under the budgeting process is to identify or have a budget committee that will govern all the processes and procedure and approval of the budget. Step 2 is choosing the budget period under the budget processes. So here it says that budget are usually prepared for a certain period and mostly commonly 1 year. So in most cases, depending on the financial period of the company, when does the company financial period start and end or financial year? So the budget will be prepared based on that. So the budget can either be prepared on a monthly basis if we're taking a look in terms of larger capital being utilized in a month period. So therefore, we're gonna also forecast it on a monthly basis. And then if we're taking a look at money that is like spended on an averagely basis, then we're gonna look at a quarterly basis, just like that. So if there is much activity happening, therefore most of the time we find budget being prepared on a monthly basis to be able to assess on which specific months we are going to run at a cash flow. So choosing a budget period depend on the financial strength of the company. So companies that know that they do have enough financial strength, they normally prepare their budget on a quarterly basis because they know that their capital can be able to be utilized over a period of 3 months or 4 months. So here it says that an organization budget period will normally coincide with the financial year which the company operates, to say that the company was started in February, so its financial year start in February and end in January next year. So here say because this is the easiest to compare actual results with the budgeted results. So it continued to say that the number of firm uses continuous budget and a budget system that has in effect a budget for a set of number of months, quarterly or years at all times. So when we choose also the budget period, we also get to forecast a long-term budget, which the CFO or the audit committee will then use the current financial year period budget to adjust the future earnings or the future cash flow of the company, to say that this is how much we are estimating based on the current budget that have been proposed. We expect in the next coming 5 years that this is going to be the new, this is going to be the financial cash inflow and outflow of the business using the current forecast. So that's what the audit committee also gets to do. So a step three under the budget process is to develop the budget guideline, what will govern the budget preparation and as well as the utilization of the budget. So here it says that an organization develops its budget guideline for the coming period based on its strategic goal and long term, and one responsible of the budget committee is to provide this initial budget guideline that set the tone for the budget and govern its preparation. All departments must follow the initial budget guideline in preparation of their budget. So in some cases, we find that companies get to adopt different types of budget. We've got activity-based budgeting, where company will estimate that or will use to say that on their guideline that for every department you are going to adopt an activity-based budgeting, meaning that when you prepare your budget based on the number of activities that are going to be performed using the following rates, which we have been identified that for each and every activity that will be performed, it will have its own specific rate. And then we also have got zero-based budgeting, where if the company adopts that under its guideline, it will also state that when preparing a budget for the next coming financial period, the current or the previous or historic budget will not be of use, will just only be used as a guideline or indication in a way that that the company will look into it to see how the company have been surviving, and it will just give the company direction in terms of preparing the new budget. Every item that will be presented in the budget will have to be defended to say why are we including this amount, this item in the budget, and why this amount, because everything starts from zero on the following year under the zero-based budgeting, except things that are under continuous process, such as your depreciation. Those we know that they are fixed, they are always gonna be there. So things such as your stationery, things such as our refreshment cost, traveling expenses, all of those will have to be justified why we are actually including them in the budget and why at that certain price under the zero-based budget. So that will be the guideline that will govern the budget process if we were to adopt the zero-based budget. And then we've got the flexible and the fixed budget. So those are other types of budget that the management can decide to take in and base their guideline on that concept. And then step four is the step of preparation of the initial budget. So here it says that each responsible center now need to prepare its initial budget proposal based on the initial budget guideline. So there are internal and external factors to consider when preparing an initial budget proposal, and some of the internal factors might include change in availability of equipment or facility, adoption of new manufacturing process, change in the product design or product mix, and introduction of a new product. So mostly when we consider a new budget, these are the internal factors that you will consider. I'll just make an example where you find that you are actually producing a product that is not actually generating more revenue. So what will actually happen is that management will decide to say that with the full capacity or 80% of this product, of this machine capacity, or of this facility will therefore be used to produce the other product that is generating more revenue. So that means that there will be a need for change of manufacturing process as well as product design. So meaning that machine will be molded. So those are the things that will be considered in terms of the budget, because now the outflow of cash will now be based on the additional increase of the other product and a decrease of the other product. And if a new product is coming in, also that will also be considered. The external factor will be talking about the price of raw material from our suppliers, or the price of that our suppliers are giving us in terms of supplying our product. Economic condition, identifying the new selling price in terms of the demand or which is there in the market. Do we have demand? Is our price still relevant in terms of what the market is offering in terms of our competitors? Those are the external factors that will affect the budget preparation, so we also need to consider those. And then lastly, we'll then talk about we'll then also talk about the step number 5, which is the approval. But these are some of the external factors that you can consider. Change in the labor market, which is the increase in the minimum wage if you are using unskilled labor, semi-skilled labor, and skilled labor in your business. So unskilled labor will be paid based on the minimum wage per hour, and therefore when this gets to change, therefore you'll also get to show the changes. Availability of raw material and the price, this is the one I was talking about, the supplier. Industry outlook for near term, and then competitors action. So these are the things that you'll have to take a look into when preparing your cash budget or your master budget. So step 5 will be the budget negotiation. So under this step number 5, so ahead of each department you need to examine the initial budget proposal to determine whether it is within the budget guideline, and then the budget operation must also be inconsistent with those of other budget units, including all units directly and indirectly affected. So this stage of the budget process can be rather time consuming and involves all budget units. So meaning that for each and every department that have to prepare their own budget, they'll get there and get to defend and get to assess to say that if you are giving the following department the following budget, and we are almost performing the same, we're also bringing the same or we are both having the same impact in terms of the companies being able to achieve its specific objective. Therefore, we need to have at least something equivalent in terms of the budget allocation or the capital allocation that is going to be used. So this is where most people get to fight in the business because of trying to get the best for their department. So this is where all the negotiation happen. And once the negotiation happens, then we then talk about the review of and approval of the budget. So a budget unit approves their budget, and then the budget goes through successive level of organization until they reach the final level of the audit of the budget committee, which will then allow and review the budget and approve if everything is still within in line of the capital provided or capital availability, as well as the guideline that was set and the overall strategic plan of the organization. So the committee will give the final approval, and then the CEO then approves the entire budget and then submits to the board of directors to say that this is what the companies aim to achieve this financial period. This is how much capital will be needed, and this is how the capital will be spent over the financial period. On a monthly basis, we expect the following. Under the following month, we get to see that we're going to run at a deficit, so therefore we're going to need more capital. So we're going to utilize the borrowing sources so that we get to try to avoid to have an impact in terms of companies' interest, losing companies' interest over new investors. So those are the things that will be discussed once the budget is approved. So then lastly, the last thing that will be the revision. Revision is more like an audit in terms of to say that what we budgeted, is the organization still following what we budgeted, is every department still utilizing, at the over under budget, over budget. So this is all what will actually be happening. So here it says that the downside is that responsible center may become disgruntled about the constant workload, and they may opt to not prepare this budget with due diligence. And then we talk now about the master budget. I've also explained that the master budget involves two types of budget. It involves our operational budget as well as our um, financial budget, where under the operational budget we talk about those that are involved in terms of revenue generation, production budgets, such as our raw material budget, our direct labor budget, our overheads budget, and then all of this will lead to us preparing a forecasted financial income statement. So here it says that the master budget, it is the comprehensive and all-encompassing it is the comprehensive, all-encompassing budget for the entire enterprise and comprises many interrelated budgets, including both operating and financial budget. A master budget is often called a static or a fixed budget because it stays the same when the volume of activity changes. So the master budget is essential, a summary of financial projection contained in the operating and financial budget, where under financial budget now we talk about our cash budget, our capital expenditure budget, our cash flow analysis or our cash flow budget, where we're going to take a look in terms of how much money we're going to bring in and go out of the business, and how much we're going to bring in from the operation of the business. So all of those will be done under the financial budgets. So this is a graphical illustration of what master budget almost look like. So what we are showing you here in terms of this picture is just only the operational budget. So this is not a full master budget. This is an operational budget where you get to talk about the production, and before production here we need to have sales. So we're gonna have sales here, which is gonna be forecasted to say that these are the amount of sales, or these are the amount of units we expect to sell. And from this amount of units we expect to sell, this will then direct the production to say that this is how many number of units we need to produce if this is how much we need to sell. And then from there we're going to talk about the material that will be used, the material, where under the material we're going to talk about the purchase of the material, the usage of the material, the ending inventory if we desire ending inventory, and then we're going to talk about the labor. We're going to talk about the laboratory overhead, which is the machine overhead, where we're going to talk about the variable and the fixed, to say that every time we use the machine it's going to be depreciating. We still need to pay factory rent, so that this will be falling within here. And then all of these will form part of the production cost, where we're going to talk now about more of we're going to now talk more of the cost of production budget. We'll talk about the full total cost of production, so that this is how much you expect to spend. And then we'll also talk about non-directive, which are these are non-manufacturing costs, which are related to overseeing that this process of manufacturing and selling gets to be done properly. So there will be budget for those people, salaries of your administrator, salaries of your supervisors. So those of all would fall within the non-direct administrative cost budget. And then lastly we're going to have the budgeted profit and loss, which is becoming from the sales minus the production cost minus the administrative cost. This will give us or determine how much profit or loss we're going to make in the next coming financial period. So this is all the operational budget. So it is just talking in terms of how we are going to generate money. And then in terms of a financial budget, we're then going to take a look, how much money do we need to spend? Financial budget, how much money do we need to spend? So this will all be on this financial statement. We're going to be taking everything that is within this cycle. to say that this is the amount we are going to spend. And then we're going to also go and say how much money do we expect to receive from our customer. Then we're going to take a look in terms of the cash sales, the credit sales, and all of this will be used to draft our cash budget to see if we are going to have sufficient cash or receive sufficient cash to be able to cover all the expenses in a specific month. So that's under financial budget. So one of the last thing is monitoring performance against the budget. So it says business plans convey a variety of budgets and expressing the expected activity of the business for a near future. So a contingency plan can then be a set in motion if the actual results differ from substantially. So meaning that we get to use the budget to assess if we are still going to achieve our specific objective, which is to make that specific profit. We're still gonna have enough money, and if we're not gonna have money or there's something that is going wrong, we then say that we have a budget variance, which is the difference from what we budgeted and what actually happened. So we call that a budget variance. So the variance can either be positive or negative, favorable or unfavorable. When it's favorable, it means that we went beyond and managed to perform better than what we budgeted. If we're talking about income, it means that we make more money than what we budgeted to receive. And then in terms of expense, we went and spent less than what we budgeted to spend, so that will be favorable in terms of expenditure or cost. And then where it's going to be unfavorable, we spent more than what we budgeted, so that's an unfavorable. In terms of revenue, we sold less than what we expect to sell, so that is going to be an unfavorable in terms of income. So those are what variance will actually look like. So you can take a look at example number 5e, which is going to be explaining the difference in terms of variance analysis, which I believe you will find it much easier to understand because of the previous lessons that we did in terms of preparation of a budget. So what is actually happening, we are comparing the budgeted result and the actual result, and we get to see if we deviated from what we budgeted, and then the result can either be favorable or unfavorable based on the terminology I just said, to say that if you budgeted to sell 1000 units and you went and sell 800 units and then the selling price stays the same, that means that we made a loss. That's an unfavorable variance because we didn't manage to receive what we expected. And in terms of expenditure, if you budgeted to spend 1000 and you went and spent 800, that's a favorable variance, to say that we were supposed to spend 1000 but we ended up spending 800, so we at least saved 200, so that's a favorable. But in cases where you're supposed to buy 1000 item and for 2 rand, and then you went and bought 1000 item for 5 rand, so that's an unfavorable because now your price is going up. So there are a number of causes of a variance. Variance can either be caused because of activities that we budgeted that we're gonna perform, to say that we are budgeted to buy 1000 item for 2 rand, but then because of changes we find that the product quality actually have to be improved. Instead of using 1000 material, we went up and use 1005, so the price still remained the same, so meaning that the cost went up because of the usage of material or of the volume of the product that were required. So therefore those are type of variance. And then we also have got a variance of price, where it's the changes or the difference in the actual budget and the budgeted, it's caused because of that specific price. So that's what actually gets to happen when we take a look at the budget variance. So this is the end of our lesson. So if I would like you guys to go and take a look at example number 5e, which will then elaborate more in terms of the variance, even though I already put in everything that you actually need to know, which makes it easier for you to be able to spot whether we have a favorable variance or an unfavorable, and whether this variance is it caused because of the volume or is it caused because of the price, where the price went up based on what we budgeted. We still bought the same number of units, or we still produced the same number of product, but our price went up because we bought the material at a higher fee. So that is what the variance will actually do. So this is all you needed for this lesson in terms of budget processes and master budget and things to be considered when performing a budget and also reviewing a budget. So the review of a budget, it's one of those where we get to monitor, control, plan, as well as to motivate employees. So those are the functionality of a budget. So please stay tuned for our next lesson, which is going to be chapter 6, costing and pricing of a product or of a service. So this is going to be our next lesson, which is going to be lesson number 24. Please make sure you tune in and watch the video or the recording so that you can be able to gain more understanding of the concept of costing and pricing of a product. Thank you very much for coming in. We shall see each other on the next coming lesson.